Tax for Businesses 4.0. Business income tax. Individuals, companies, and trusts all could have business income, and they need to file T1, T2, and T3 respectively for income tax. This video will focus on income tax for companies, T2. 6 areas will be covered. 1. Who needs to file corporate income tax? 2. Filing deadlines and payment deadlines. 3. Corporate tax rates and types of corporations. 4. What income is taxable? 5. Deductions and tax planning opportunities. 6. Compliance, records, and CRA, tax authority expectations. 1. Who needs to file corporate income tax? Incorporated companies versus sole proprietors. Active business versus holding, investment companies. Even if no income, many corporations still must file. Any incorporated company usually must file a corporate tax return, T2, every year, even if there is no income or the company is inactive. 2. Filing deadlines and payment deadlines. Fiscal year end, FY, versus calendar year. Your FY can be different from calendar year. Filing deadline, usually 6 months after year end. Payment timing, often 2-3 months after FY. Consequences of late filing. Late payment. The return is generally due 6 months after year end, but tax owing is usually due earlier, often 2 to 3 months after fiscal year end. 3. Corporate tax rates and types of corporations. Basic corporate tax structure. Small business deduction. Lower rate for active business income. CCPC versus non-CCPC, if in Canada. Federal plus provincial rates. 9% plus 2%, 11% for small business, lower than 27% generally. Corporate taxes depend on whether the company qualifies for the small business rate and also vary by province and income type. 4. What income is taxable? Active business income, investment income, capital gains, 50% taxable. Foreign income and reporting requirements. Active business income, investment income, and capital gains are generally taxable, including certain foreign income that must be reported. 5. Deductions and tax planning opportunities. Reasonable business expenses. Depreciation, capital cost allowance. Loss carry forward. Carry back businesses can deduct reasonable expenses, claim depreciation, CCA, and use loss carry forwards or carrybacks to reduce taxes. 6. Compliance, records, and CRA. Tax authority expectations. Bookkeeping requirements. Retention of records. Possible audits and risk triggers. Importance of working with a professional. Good bookkeeping, proper documentation, and on-time filing help avoid penalties and reduce audit risks. Understand your taxes, stay compliant, save money. We can help and can be reached by the following.